The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings, I'm Mike Hurley, Chief Market Strategist with NexPoint, with your weekly market deep dive for June 21st, 2021. Well, we're going to start this week the same way we did last week, by reviewing the work of one of our favorite analysts, Barry Bannister. We don't usually do this in back-to-back weeks, but the comments Barry made last week seem to be playing out in the marketplace. Remember, he looked for the next 6 months to have a stronger dollar, weak commodities, weaker stock market, and Bitcoin going to 12,000. So far, it looks like the market is cooperating in. From the top left chart, you can see the strong bounce in the dollar last week, the Bloomberg Commodity Index rolling over a bit from 95. And while you haven't seen much of a correction yet in stocks as measured by the S&P, we may be entering a corrective phase, and we'll go into that later in the brief. Starting with our normal commodities and foreign exchange slide, again, looking at the middle on the weekly charts of the US dollar, you can see that strong bounce in the US dollar. Last week, we had noted that this stochastic oscillator, the red and blue line, had crossed, meaning the blue crossed back above the red, which is usually a trigger for an impending rally, and sure enough, we got it. The pane below is the euro measured in dollars, and you can see a strong dollar is commensurate with a weak euro. Going a little bit lower on the chart, you can see that pullback in the Bloomberg Commodity Index, and below it is copper, corn, silver, gold, which are all starting to enter corrective phases. Only time will tell how much correction these do see, but again, so far the charts are bending and not breaking, and it continues to look like a strong bull market in commodities, but one that definitely needs a few months to pause and refresh. Looking a little more tactically at Brent crude as well as gold, you can see the oil market remains in a very strong uptrend. The line below crude is the difference between the 1 month and the 12-month Brent contracts. And you can see the market remains in strong backward fashion, which is usually a supportive of higher prices. You can also see those higher prices are coming to fruition in that the price of Brent on, again, both the 1 and 12-month contracts have not only broken a downtrend, but gotten back through this area of resistance in the high 50s. So again, we continue to be bullish on the crude oil markets. Gold, on the other hand, is a bit of a mixed picture. Gold usually is supportive by the difference between break-even yields and actual yields, which we plot here in the blue and yellow lines. The bluish or teal colored is the difference between the 5-year break-even and the 5-year yield, and the yellow line, the 10-year break-even and the 10-year yield. So again, rising line here usually equates to rising price of gold in both dollars and euros. What's different, however, is they've started to diverge, meaning the 5-year has remained firm and the 10-year numbers are weakening. The last time that happened was in 2013, which was ahead of a pretty meaningful top in gold. So it's definitely something that we're keeping our eye on and make sure that this pullback in gold holds. Looking a little more at yields globally, I'm going to start with those in the US because last week was a very interesting week. And again, largely due to those hawkish comments coming out of the Federal Reserve. If you look at the green line on the chart on the left, this is where our yield curve is in the US right now, or as of last Friday. If you look at the dotted brown line, you can see where it was a month ago. And again, you can see a definite flattening in the yield curve, meaning the long end of the curve up around 7 and 10 years dropped, as evidenced or annotated by the red arrow, whereas the short end of the curve, the 2 and 3 year part of the curve, jumped up. So again, a definite flattening in the yield curve since the short end moved higher and the long end moved down. The yield curve still remains upwardly sloped, which is healthy and definitely steeper than it was 6 and 12 months ago. So again, we think a correction within a longer term healthy environment. By healthy environment longer term, you just need to look at the chart on the right and you can see the steep rise in interest rates over the last 12 months, starting with the COVID low, 10-year break evens have moved up dramatically from under 1 to 2.5. That led the US 10-year Treasury, which again bottomed around 50 basis points and has made it all the way up to 175. Several months later, the UK and German rates moved higher, and again, low and stable rates in Japan. Looking a little more tactically at the US 10-year, you can see in the daily chart in the top left, it remains in a downward sloping channel, which looks a lot like consolidation to us. The reason we say consolidation is, again, looking at the monthly chart below or the weekly chart on the right, the interest rates have moved pretty dramatically off that 50 basis point area. And again, it's natural to see a couple of months of consolidation, which is what we're seeing both on the weekly and daily charts. I also wanted to point out we have a slight change to the chart this week in that normally the brownish or olive colored line, which represents the 5-year yield or the yield on the 5-year Treasury, is usually a solid line, as the green one below, which is the 3-month T-bills. But I did a bar chart this week just to show you how the shorter end of the curve moved higher, whereas the 10-year was flat to slightly lower. So again, that's another good way to look at that steepening, or I'm sorry, flattening in the yield curve that we saw last week. A bit of a surprise were credit spreads, in that they remained low and stable and even got a little bit tighter on the week. Again, the market was a little bit in rough shape toward the back half of the week, and you'd expect credit spreads to widen out a bit and not move lower. They didn't move lower by much, but again, they did move lower, and they remain very low and very stable at this point in time. Very much a tailwind for the stock market. Looking at our longer term view of the US markets, I'm going to start with the value line slide because, again, this gives us a great view of the longer term market picture. If you can look back to 2002, one of the favorite indicators we use to define whether we're a bull or bear market is the percentage of stocks above their 200-day average, which is this blue line across the bottom. As long as that number holds above 40%, which is where the dashed line is, you can assume stocks are in a bull market. When that crosses from below 40 to above, I've marked it with a green vertical line. And when it falls back below 40, you can see it as a red vertical line. So again, indicator that lags a little bit, but does a great job of identifying bear markets and bull markets in succession. The other thing that's notable about this chart or this indicator is that it often diverges for an extended period of time before the market sees its final high. So our point being, since we're likely early in this bull market, since the indicator just crossed above 40 toward the middle of last year and the average bull market lasts 3 years, we're obviously not yet seeing any divergences in this indicator. So while the value line was down 4% on the week, it hardly looks like a blip. We do think the market could correct further, but again, a correction is very different than the start of a new bear market, which we think is still pretty far away. Looking a little more tactically at the stock market, we've got daily charts on the left of both the S&P 500 as well as the NASDAQ composite. And you can see the back half of the week was not kind to the markets, particularly the S&P, where Wednesday and Thursday and Friday did see some weak action. Now, the market did hold its 50-day moving average, which is a natural spot to hold. But again, we'll have to see if that holds longer term. The reason we say that is while the market didn't see any heavy dumping or real negative market internals, meaning a large number of new 52-week lows or a huge ratio of declining stocks to advancing stocks, which was really just down around 3 to 1, you have now put divergences in place. And divergences can be defined as when the market goes higher or the S&P 500 index moves higher, yet the indicators behind the scenes, such as the number of stocks making a new 52-week high, do not move higher, and in fact are showing a lower high. You can see the same type of setup in the RSI, or the relative strength index, in that in April, it made a high above 80. And even though the S&P 500 went higher last week, the RSI did not go higher, forming a divergence in momentum. Those similar divergences can be seen on the weekly charts of the NASDAQ. So again, as the NASDAQ was battling the 14,000 area, you saw a tremendous number of new 52-week highs around 1,000 the first time it was in this area, the index. Yet here we are at the same area in the index and roughly 300 new 52-week highs. So again, apples to apples means the NASDAQ is at the same area, whereas the number of stocks making a new 52-week high is not. Looking a little further to the right, you can also see that that correction is starting to take hold, not just in the S&P 500 and some of the other indices as well. Looking at the Dow Jones Industrial Average, you can see that it slipped through a minor area of support around 33,500. The Dow Transports had a rough week. The mid caps also falling through a minor area of support. And the Russell 2000, which we noted last week, may be breaking out of a triangle, has definitely reversed that this week and looks to be falling back in that trading range. So at the end of the day, while we're in a strong cyclical bull market, which lasts a couple more years, the market has come a long way over the past year and certainly entitled to a resting period or a healthy consolidation. Looking at the individual market sectors, I've sorted the table on the left by weekly returns, and you can see the only sector that was really up on the week, and it was not up that much, was the tech sector. The XLK was up 10 basis points, but at least it's in the green, whereas a lot of these sectors were in the red. In fact, the energy sector, the basic materials sector, and the financial sectors, which are really just banks, have now been down 2 weeks straight, with this last week pretty stiff, down between 5 to 7% in those three ETFs. You can also see that the only real place to hide last week were the large cap growth stocks. So again, think technology, where the IWF was up 0.5%, and the other three style boxes down anywhere between 2.5 to 5.5. So definitely the FANGs were the place to hide, which is kind of ironic to say since they've had such a bad reputation of being volatile stocks. Finally, if you look at the fixed income market, you can see again, US Treasuries, which are higher quality fixed income instruments, were strong, whereas as you go further down the quality scale, you see more and more weakness. Investment grade were only up 0.5%, and high yield bonds were actually down 20 basis points. You can also see the nervousness in the market based on the volatility curve. This top left chart is the volatility curve this week, and the one just to the right, or the top center, is the volatility curve a week ago. The difference is plotted to the right, and you can see sharp moves up on the left side and the right side, but in both cases they were at the 1 month tenor, meaning people were buying 1 month out of the money calls, but much heavier 1 month out of the money puts. So definitely a nervous market, or a market that is getting increasingly nervous, I should say, whereas market participants are really starting to bid up some of those far out of the money puts on a short-term basis. Looking a little bit more at some individual sectors, you can see three sectors of note across the bottom, we believe. While the technology sector was the strongest last week, we think one of the reasons is the action in the semiconductors. If you look at the charts of skew here at the bottom left on the semiconductor sector, you can see put skew is down near the 20% or 15 to 20% area, and call skew is up around 100. This wide difference means that the market participants have an increasingly, or a very bullish view of the semiconductors, largely, we believe, due to the chip shortages that are still nowhere close to being solved. Another market that has a very positive structure with regard to skew is the oil and gas sector. So again, think exploration of oil and gas, whereas call skew is up around 100th percentile, and put skew, while it moved up last week, still remains contained below 20. So again, a bullish configuration in the energy markets as well. We mentioned earlier that the dollar can have an adverse impact on the emerging markets, and that's just what we're seeing in the options markets. You're seeing put skew in this case approaching 100%, and call skew, while not down around 20, certainly slipping and certainly below put skew. So again, a bit more of a defensive tone to the emerging markets, largely based on that move in the dollar last week. Finally, looking at the little more specifically at the overseas markets, we've shown a couple of things here that we're trying to put into groups. If you look at the red rectangles of the developed markets in the center pane, meaning the German DAX, the French ETF, and the UK ETF, along with the Indian ETF and the Russian ETF, you see a theme of markets which have been strong, but had a rough week last week. We think those are strong markets that are starting to fall into what may be extended consolidation ranges. As for an extended consolidation range, what we're expecting or looking for, and while it's very difficult to predict, the green blocks, which show the Japanese ETF as well as the Korean ETF, show what is a very healthy, normal situation and what those red blocks could turn into in the months ahead. Again, markets that led the way higher, peaked in the January timeframe, and really have just kind of gone sideways the last 3 or 4 months and built healthy consolidation ranges, which digest their gains in an orderly manner. Finally, 2 of our key canaries are those Chinese markets. And if you look at the top right part of the chart, you can see both the MCHI ETF as well as the A-shares ETF. Both rallied strongly early last year and led the way higher for global markets everywhere, but both have also led the pullback. So since pulling back to their 40-week moving average, both have found support, bounced a little bit, but we think there may be another test ahead, and how this test holds in general will be a great window for markets everywhere. Given the Olympics right around the corner, we thought we'd take a deep dive into the Japanese markets, and we're seeing a very interesting picture. First of all, the markets look in great shape, but the culture of the Japanese people really is the opposite right now. And what we mean by that is if you look at how the people within Japan are reacting to the recent spike in COVID, it's been incredibly negative. The bottom chart on the left shows the number of COVID cases in Japan, and you can see the spike they're seeing right now is very similar to the one that happened in early January. So a pretty significant spike. If you look at what is going on in the world, there is literally marching in the streets, which is pretty unheard of for the Japanese people. And a full majority of them are demanding the 2020 games in Tokyo be canceled. Fully 80% of the people in the country want them either canceled or postponed. And if you look at the documents they're giving athletes when they show up, it's 70 pages of behavioral guidelines of what they can and can't do while they're in Tokyo. And they're requesting or insisting that all athletes leave within 48 hours of their last event. So again, whole lot of fear surrounding COVID in Japan right now, which is impacting and potentially impacting the Olympics, which the IOC can unilaterally cancel. So far, Prime Minister Suga intends to allow spectators into the games, and that was as of 6/17 or late last week. Taking a deeper dive into the markets, though, we've got monthly charts on the left that go back 30 years and weekly charts on the right that go back about 5. If you look at the Japanese currency or the yen, you can see largely been in a sideways market or a stable value over the last 30 years. But over the last 5, a grinding trend line lower. Well, that grinding trend line has just been broken, and it would be very natural for the Japanese yen to get back up to the top of this range where we have this dashed line around 125. As for interest rates in Japan, you might remember from a few slides ago, low and stable is where they've been right around the 0 line for quite some time, which is good news. And the Japanese stock market, measured by the Nikkei 225 average, has been quite healthy lately. If you look at the last 5 years, you can see the strong move from the COVID lows around March of 2020. Getting through 24,000 was a very big move technically. And like that chart of the Bloomberg Commodity Index, you can see a very tight flag here forming, which is generally a bullish formation. Stepping back and looking at the big picture, you can see that the move takes it out of a very large base that has been building over the last 30 years in the Japanese stock market. So we think there's a very good chance over the next several years to revisit those highs in the 38,000 area, which were set, I believe, on December 29th of 1989. The Nikkei then spent the next decade or 2 decades grinding its way lower after forming a high on the last trading day of 1989. Looking at our COVID slide of the week, there were some interesting developments, or one in particular within the COVID data. So first of all, the top left at point A continues to show a decline in both cases and deaths in the US, which is of course great news. Interestingly, in the top right at point B, the Wall Street Journal is now reporting that COVID was actually in the United States in December of 19, several weeks before official confirmation. The fascinating chart in my mind, however, is the one below it, which shows the age-adjusted death rate in the United States going back to 1900. It's a little difficult to see, but if you download our slides, you can blow it up. The point that's so interesting is you can see an uptick in age-adjusted death rate in the United States for 2020, which is no surprise. What is a surprise, however, is that the death rate moved from 7 in 1,000 to 8 in 1,000. So not a big jump at all. In fact, it puts it back at the same level seen roughly from 2000 to 2008 and below levels seen in the 1990s, 1980s, 1970s. So again, while it may seem from the headlines to have been a very dangerous world we lived through in 2020, it was actually safer based on age-adjusted death rates than the world in the United States in the 1990s and 1980s, which is a fascinating piece of data. Finally, you can see mobility rates continue to climb as everybody gets back to work and on with their lives. And the 3 F charts show the various status or vaccination rates, various ways of being shown. So finally, in summary, what was important last week was that hawkish FOMC meeting, which caused several dominoes to really move forward. The first was the dollar bouncing smartly off this 90 area. Again, you can see just how important an area it is based on this monthly chart, which goes back 8 years. And you can see how far the dollar could bounce if this area holds. You can also see the recovering commodities over the last year compared to the longer term trend as well, and how it's reversing that, and how the pullback in copper definitely is significant, but it's also just a pullback in a bull market. As for yields and credit, you can see the move in the 10-year treasury back through that 130 to 140 area, which so far is holding, and the fact that the credit ETF or LQD remains in a strong uptrend as well. So credit remains supportive to stocks in general. Stocks have obviously been strong over the last year, but that being said, we're starting to see some weakness and some divergences, which suggest we could fall into a larger trading range. What would change our thinking would be if the NASDAQ pops through this 14,500 area and again, re-embarks or re-engages on its uptrend, because again, this would take the shape of a 4-month consolidation, and that would be enough for the market to pause and refresh. That being said, if you look at the right-hand side with the Dow Industrials, the Dow Transports, the mid caps, the small caps, they're all looking a little bit heavy. So again, we think the odds favor for a continued correction or consolidation in stocks over the next few months. I've been Mike Hurley with your weekly market deep dive for June 21st, 2021. We hope to see you again next week.